Nikunj, I think we are going through a transition phase where broadly at a macro level, with the Fed signaling a significant tightening going forward and 3 rate hikes, I think the markets have to adjust to that. And I think that is what is happening. And usually what happens is that in a market, after the first rally, there is usually some excesses that are built up, and markets always have to correct. And you always find reasons. So we can ascribe reasons, but in my view, I think it could be a combination of the fact that Omicron is back, and the Fed has signaled a turnaround. And I think investors might have got a little bit spooked, because if you look at the actions of the Bank of England, right? So you have Omicron cases in UK going up at the fastest rate, and despite that, the BOE has had the courage to go and hike rates. That tells you that central banks are no longer worried so much about Omicron as much as they are worried about inflation. So I think this needs to get priced into the market, and usually, you do see that reasons follow, but if the markets have to correct, they do correct. And I think that is what we are going through right now.
So Hiren, for markets to come back, what could be the trigger? Will it be pure valuations and reversal in money, or you think we are in for a long winter?
See, Nikunj, I think that in my opinion, the biggest reason why this market will sustain and pull back is the earnings growth and dynamism that we've seen through probably some of the worst period in the economy during 2020 and 2021. Nobody expected that earnings would grow in double digits or 20%, right? So on the back of last year's 20% and this year's 25+% earnings growth in 21-22, I think on a base of 100, earnings have already gone up to 145, 150. And if you look at pre-COVID Nifty, we were at 12,000 and we touched almost 18,000 and now are correcting, right? So I think it is the earnings and the confidence and the durability in the earnings that will bring investors back. So I have no doubt that the next leg of rally, the baton is being moved from liquidity to earnings. I think earnings were already there, but I guess that, as I said, we are going through this transitory phase. Even in roaring bull markets, you have, very sharp, short-lived corrections. My feeling is that, you could possibly say that the Nifty may be range-bound over the next 6-9 months. It's happened in the past, but individual stocks will do phenomenally well. So I think you may have a situation where the headline indexes don't do much, but individual stocks and sectors could do better before the Nifty catches up back again.
Hiren, I know we've got just another 4-5 minutes with you, but you have got banks which represent the proxy to the economy. And if the economy is supposed to do well, banks will have a rub-off effect. But the biggest proxy, which is banks or AMC, they are underperforming. So are markets telling us something which perhaps today we are not able to understand?
So Nikunj, I think, that, there are 2-3 things at play here when it comes to banks. I know that, very simplistically, banks are the best proxy if you want to play a growing economy, right? But there are 2-3 things which are at play here. One was that I think private banks and NBFCs were the leaders of the previous bull market cycle. And we all know from experience and hindsight that a new bull market has new leadership, right? And I think that there was a time when, banks almost constituted 40% of the index. And I think there is some manner of stealth mean reversion that is happening, where the over-indexation of banks, is now self-correcting. Partly it happened because of COVID and what it did to bank balance sheets and the fact that they had to raise capital urgently. I think now in this phase, to my reckoning, what's also happening is that banks are getting derated because of the onslaught of fintechs. And today the investors are not able to dimension what this disruption could mean to banks' earnings, right? So everybody has a hypothesis. We do not know. We will only get to know in the subsequent quarters whether the fintechs have been able to durably impact some part of the value chain in the banks, right? So earlier, the banks could keep the entire value chain to themselves. Now, that value chain is broken into several components, and the fintechs are attacking some of those components. And unless we know that how this disruption is going to play out, there could be an overall stealth derating of the sector. Thirdly, I think usually banks tend to do well when interest rate starts to move up, which is when their pricing power comes up, their NIMs come up. And that's when the franchise of some of the banks who have a very good liability franchise where they can get low cost deposits and deploy it or lend it at higher rates is when they start to make money, right? So I think that cycle where interest rates start rising in India could be a couple of, 1 or 2 quarters away. And I think that today investors are not able to dimension what the fintechs could do to the earnings power of some of these banks. But this will get settled, in my opinion, in the next 6-12 months. We've seen such disruptions play out earlier. The classic case was Patanjali, right? When they came in, the entire FMCG sector got disrupted because people felt that here is a disruptor, he could come, he could impact margins. So Patanjali came, they took some market share away. Now everything is settled. Now nobody talks about Patanjali. And also some of the existing incumbent players also adapted and they came up with their own offerings in the Ayurvedic space. And now, everything is kind of settled back and things are back to normal. I think something very similar could happen in banking. The fintechs come in aggressively. We don't know. I think there is regulation which is still evolving in the fintech space, right? Everybody thought that UPI doesn't make money. And therefore, a lot of banks ignored UPI. And now suddenly you have so many transactions that are happening on the UPI platform. Now, with one stroke of regulation, if tomorrow the RBI decides that there will be an MDR for UPI transactions, so people who are very significant high market share in UPI transaction could suddenly get a leg up in profitability. So I think because the financial services space is going through some kind of a disruption and evolution, I think that investors are taking their time. And if I were to just read the market and what's happening to the sector, I think these are 2 or 3 things that are happening. They were leaders of the previous bull market. Therefore, they have to, if you look at past trends, they may have to consolidate. And there is some mean reversion that is happening. And then on top of that, we have the disruption from fintechs.
And exactly 1:30. As promised, we'll not extend our appointment beyond that. You got a busy day ahead, but really appreciate your time that you were able to join us on a day like this. And in general, people are looking forward for some solid advice from a stalwart like you.
Thanks, Nikunj.